Well, hello and welcome to the Hammond Iles Financial Power Hour. Every month we strive to provide you additional information that can create a clear path to purposeful living. We strive to work with investors across 3 generations to assist them in living a life of freedom and fulfillment. And today we're trying to create some fulfillment and some freedom by creating simple steps for a smooth tax season. Filing taxes, I often think about as almost like putting together a piece of furniture at IKEA. You have confusing instructions, there always seems to be some pieces missing, and at the end, you're really not sure if you actually did it all correctly. So today, we're going to walk through some simple steps that hopefully will clarify some of those confusing instructions and make your tax season a little bit smoother. Now, as part of our normal disclosures, although I am a licensed CPA, Hammond Iles Wealth Advisors does not provide tax or legal advice. So with the information that we're providing you today, we recommend that you consult with your tax advisor. And so, as I mentioned, we will be accepting questions via chat, as well as at the end, we'll open up for you to either submit questions through the chat or you can raise your virtual hand and we'll answer your questions that you can ask verbally. So what are we going to cover today? Well, there are a few steps to having a smooth tax season. And the first is really determining whether you need tax preparation help, and we'll utilize the services of someone professionally or do it yourself. You need to be able to organize your records and want to point out some of what those records are and some of the time frames on when you can expect to receive them. Also, we're going to talk a little bit about reviewing potential deductions or credits that can impact your income taxes. And I want to encourage you to max out your tax advantage account contributions if you're eligible to make those contributions. And then to start to wrap up, we're going to talk about some strategies to implement for next year, already starting to plan for the following tax year, and some important things to know to wrap up. So let's go ahead and get started in talking about, do you need to utilize the services of a professional tax preparer or possibly use kind of an online software yourself? There's not many people that I know of that still fill out the forms by paper, but there could be some of you out there. But some of the questions to make this decision that you might ask is, did you this year receive income from just one or two employers or sources? Certainly that's going to be a little bit easier if you just have Social Security and a pension, for example. It could be an easier opportunity to complete your taxes. Did you start, sell, or close a company? Did you have a business that you did on the side, or that is now your full-time position? Did you get married, divorced, or have a spouse that passed away during this year? That may create some additional changes to your tax picture. Do you have a side gig, or do you own an investment property? Both of those have their own tax consequences and nuances that may require the assistance of a tax professional. Did you receive a sizable inheritance? Certainly there are a number of conversations that need to be had around inheritances, how they're paid out and the timing of them and the tax consequences of those inheritances. So if you received something during the year, that may be something to consider in your decision. So if you had any of these, then you might want to consider working with a tax professional. And the important thing, and one of the reasons why I lead it off as the first step, is that you want to make that decision early. Don't wait. Don't wait until the end of March to then all of a sudden decide that you want to work with a tax professional. At that point, it'll be very challenging and probably frustrating in the process in trying to get that information to the accountant. So the second step that we want to talk about is gathering your income records. So we're going to start out with income and then talk about deductions to offset that income. And some of the income records that you can look for are your W-2 forms from your employer if you're still working, 1099 forms from banks or other income payers, including unemployment payments, dividends, pension, annuities, or retirement account distributions. You may also have a 1099K or a 1099 MISC or a W-2 by independent or contract work that you may have done outside of your employer. If you had a high yield savings account, hopefully all of you have an emergency savings account earning interest, not just sitting in a checking account. If you earn some interest this year, then you will receive a 1099 INT for that interest that you were paid. If you are in the health insurance marketplace, if you're on, whether that's in Connecticut or any other of the state marketplaces for health insurance, you will receive a 1095A form that will document that you're covered for the year. You may also have other income documents, and you may also look for if you have any digital asset transactions. Although we don't recommend investing in cryptocurrencies or non-fungible tokens or other digital assets, you'll want to make sure if you did during the year that you collect those transaction reports because they are taxed differently than other forms of income. And one of the other ways to make sure that you're collecting and have everything is certainly to review your prior year tax return. So as long as you haven't opened up any new bank accounts or investment accounts or made other changes, the prior year tax return can be a great way to just take a look at what you reported on last year and make sure you have those same forms this year. Now, one of the things that we start to get a lot of phone calls this time of year is, where's my tax form? Where's my 1099? And so I wanted to talk a little bit about tax documentation and what the issue deadlines are for investment companies, banks, and employers. So there are two main dates that you need to be aware of. The first is January 31st. So if you have an employer and you have a W-2, those need to be issued by January 31st, as well as 1099 INTs from banks, as well as those other documents like 1099K and a 1099 MISC if you're an independent contractor. And if you have any distributions from a retirement account, you'll also receive a 1099R form. Now, keep in mind that the requirement is that they're distributed by January 31st. So if an employer or a bank or an investment company mails it on January 31st, depending on the U.S. Postal Service, it may take a little while to get to you. So they may have met this deadline, but you may have at this point not received it yet. So you just need to keep an eye on your mailbox. Also, one other way to deadline that you need to be aware of is February 15th. So if you have an investment account that's not a retirement account, an individual account, joint account, trust account, something that's not a retirement, you will receive a 1099 composite form. Now, a 1099 composite form, it's called composite because it's basically three different 1099s combined into one. So you may have a 1099 INT if there were interest earned inside your investment account on a money market, for example, or just the cash balance. Secondly, is you may have a 1099 DIV for dividends. So if you had investments that generated dividends during the year, that'll be reported on the 1090 DIV. And then it'll also include a 1099B if you bought or sold any investments during the year. 1099B is what reports those transactions to the IRS, or at least to you, depending on the transaction, and it will provide the cost basis and the proceeds and what your potential gains or losses were for those transactions. So those are the important documents and the deadlines that you need to be aware of. And again, February 15th is a mail-by date. So again, they have up until February 15th to mail it. So you may not receive that tax form until the end of February. Also, keep in mind that investment companies are able to file for a 30-day extension. So they could potentially extend that February 15th deadline until March 15th, potentially. Now, most companies don't want to delay the tax forms that long, but they may file for that extension and then strive to have everything out by the end of February. Some of the major investment companies like Charles Schwab, for example, they will commit to having everything out by February 28th. Now, one of the other things is that you don't necessarily need to wait for that form to come to you in the mail. So if you're looking for a form and you have an investment company, whether it's Charles Schwab, Fidelity, or any other investment company that you have an account with, you can go online and download that form directly. So you would need to have an online login for their website. And as soon as the form is prepared, it will be uploaded to their website as well as mailed out to you if you elect to have it mailed out to you. You may also want to check your spam folder in your email if you have elected to have your documents sent to you electronically. They may also have that link there that may, for whatever reason, not be in your inbox. So if you're looking for a form, you can go online and get it directly from the company. And if you have any challenges with obtaining any tax forms with accounts related to your investments with Hammond Iles, don't hesitate to give our office a call. We'll be happy to assist you with that. One other little caveat, I know certainly over the last few years, checking accounts have not paid a lot in interest, if that at all. And so just keep in mind that a 1099 is not issued for interest or dividends that are less than $10. So I know I went searching for a 1099 and then realized, well, that checking account, I only earned $6 in interest. So there is no 1099, and so it won't be reported to the IRS. So once you've gathered your income, then it's time to look at potential deductions. And do you know what the difference is between a magician and an accountant? A magician makes things disappear, whereas an accountant makes them deductible. So what are some of the things that we need to be aware of that we're looking for potential deductions that we want to either hand off to our tax advisor or have prepared for when we do fill out our own tax information online? So the first is if you have any child care or adoption costs, those can be deductible for you, as well as education costs. So you may receive a 1098 from a higher education institution if you have a child or a dependent that you are assisting with education costs. Also, charitable donations. And this may include both your cash donations as well as the value of donated property. If you did not make records of what you donated to, say, Goodwill or Salvation Army or some other organization where you're donating actual property, you'll want to make sure that you have a list and you can approximate or use some other tools to generate a potential value of those items that you donated. If you still have a mortgage on your home, you'll also want to be looking for your 1098 form for the mortgage interest that you paid. If you own a real estate, then a home, you'll have real estate taxes. You may, depending on the state in which you reside, you may also have property taxes. Here in Connecticut, we pay property taxes on automobiles. So you'll want to gather that information as well. If you had a substantial amount of medical or dental expenses during the year, you may also want to gather that information. It's a little bit more challenging to deduct those expenses because they do need to exceed 7.5% of your adjusted gross income, but it may be worth the exercise to gather those. And while I'm talking about limitations on deductions, that may also be something to look at your prior year tax return, because many individuals, with the passing of the Tax Act in 2017, where the standard deduction was doubled in size, many individuals don't itemize for tax purposes, because these potential deductions don't add up to being more than what just the standard deduction is. So you may want to examine that threshold and whether that applies to you in making that decision on gathering all this information together. You also, if you made any estimated tax payments throughout the year, you'll want to note not only the amounts, but the dates that you made those payments. And keep in mind that there are opportunities for credits if you made any energy efficient home improvements, whether that is improving things like new windows or doors to make your home more energy efficient, or the possibility of any clean energy such as putting on solar panels. Those are other expenses that you'll want to gather to potentially be able to get a credit against your taxes. Now, one of the things that is still open to be able to deduct on your taxes or impact your taxes is making contributions to tax-advantaged accounts. Just because we're past the calendar year doesn't mean that you've missed the opportunity to contribute to a tax-advantaged account if you're eligible to do so. You have up until the due date of your tax return, so for this year, that's April 15th of 2025, that you're able to make contributions. And the main accounts that we would focus on for these tax advantage accounts are traditional IRAs or a Roth IRA. For individuals that are age 50 or younger, the contribution limit for 2024 is $7,000. So if you didn't make that complete contribution and you're eligible to do so, you can still make that contribution before April 15th and have it count for your 2024 income taxes. If you're over the age of 50, you get an extra little catch-up contribution, so you can actually add $1,000 and have a total of $8,000 that you can contribute to your traditional IRA or Roth IRA. Keep in mind that there are eligibility requirements, both income-wise and the amount of income that you earn. So that may be a good opportunity to talk to a tax professional or do some research on whether you're eligible, to make sure that you are before you make that contribution. The other kind of tax advantage account that doesn't get enough conversation, in my opinion, is if you are under the age of 65 and you have a high deductible health insurance plan, you have the opportunity to contribute to a health savings account. For individuals that are under the age of 55, if it's just you as a single individual, you can contribute up to $4,150 to your health savings account. And if you're a family, if you have children that are part of your policy, or even just a spouse, so you have family coverage, you can contribute up to $8,300. For those of you that are between 55 and 65, that 10-year window, you can actually contribute a little bit more. You can contribute $5,150 as a single and $9,300 as a family contribution. Now, I highlight the health savings account because it is a triple tax benefit. If you want a refresher on that, I encourage you to go to our YouTube channel. So if you go to YouTube and search Hammond Iles, you'll find all of our 60-second Financial Friday videos, and one is on health savings account. Just as a quick overview, health savings account, you get a tax deduction when money goes in. It grows tax deferred inside the health savings account. And then as long as you take money out and spend it on qualified health expenses, it comes out tax free. So it's a triple tax benefit potentially for you. So it's a great way to put money aside for healthcare expenses later in retirement, or just in utilizing it on an ongoing basis while you're working. So those are important accounts, and I encourage you, if you'd like to research those more, go to our YouTube channel to learn a little bit more about each of them. So here are some strategies to use for next year. So you may have already completed gathering your information for 2024, but how can we kind of put some systems in place so that we have an easier tax season when we come up to our tax season next year? The first that I want to talk about is charitable donations and those deductible expenses. So that list that I talked about, keep a folder all year long. Consider creating a folder, and so then as you make charitable donations or as you incur some of those expenses, such as your property taxes, it just automatically goes into your tax folder. It'll save you the effort of having to search those down at the end of the year. And so it's a great way to just centralize the process. Now, also, many times, whether that's charitable donations online or just we're receiving documentation digitally, you may also want to set up a separate email folder, either in your email box, or you can set up a separate folder on your computer to slide that documentation into that folder throughout the year. Again, it's a great way to consolidate everything into a central location. So at the end of the year, you're not searching through your email or your bank records or your checkbook or anything, trying to figure out where did I donate money this year, or what expenses, when did I pay that property tax bill? One of the things that I do also, because of the charitable donations I make online, is I designate a specific credit card that I use for charitable donations. So whenever I'm making a charitable donation, I put it on the same card. So what I'm able to do then is at the end of the year, I log into my credit card account and I print out a transaction history at the end of the year. The nice thing is many credit card companies, when you pull a transaction history, now with technology, they may classify kind of the type of organization or entity that you paid on the credit card. So it would highlight that it was charitable or nonprofit. So it's an easy way for me to also double check. So even though I have my folder that set aside where I'm putting my charitable donation receipts into that folder throughout the year, as a double check, I can print my transaction history and go through and just make sure that I have everything that I have and something didn't slip by. Now, when it comes to charitable donations, you may also try to simplify the picture by using a donor-advised fund. I'm not going to go into a lot of examples on that, but how a donor-advised fund works in general is that you make a donation to the donor-advised fund. Inside the fund, it grows tax-deferred inside the fund, and then you can request grants out of the fund to different organizations throughout the year. There's no requirement for those donations to go out, so the money can stay and grow inside the donor-advised fund. But the nice thing about it is if you make one large donation into the donor-advised fund, whether that's cash or appreciated investments, then you have one donation letter to keep track of rather than all the different grants or donations you made out of the donor-advised fund. If this is something of interest to you, I encourage you again to go to our YouTube channel. You'll see tax strategy webinars from the last couple of years. Both of them include conversations on donor-advised funds. So I encourage you to take a look at those webinars. Also, it's very important to keep informed about changes to laws and tax information. It's one of the reasons why I encourage you to continue to watch or attend our Hammond Iles tax planning webinars. We'll be having another one coming up later this year, and our prior year ones, which for the most part are still very applicable. There haven't been a large number of tax changes in the last couple of years, but you can refresh your memory by looking at those online or keeping an eye on our website for our upcoming webinars that we'll be hosting. So to wrap things up, we're going to talk a little bit about important things to know regarding making your tax season a little smoother. One is you have the ability to file Form 4868 for an automatic 6-month extension to October 15th. Now, keep in mind, though, that there is one thing to be aware of. By filing a tax extension, it's an extension of time to file your taxes, but not to pay your taxes. So if you were to file an extension, in order to avoid penalties and interest accruing on anything amount due with your tax return that could potentially be due, you'll want to do a preliminary calculation. So if you are filing an extension, that if there is some amount due, you may want to make an estimated tax payment with your extension. Also, just the filing deadline this year is Tuesday, April 15th. So it's on a Tuesday, so you get a little bit of weekend before that. Also, it's a good practice to print, sign, and date a copy of your tax return for your files. It just documents that it was filed and with your personal signature for your files. If there is an audit or any review of your tax records later, it's just a documentation that you signed and dated it as to when it was filed. Also, I get the question, well, how long should I keep my tax returns? My dad liked to keep his tax returns forever. So when he passed, we did a lot of shredding. But typically, the IRS can come back and audit your tax return for 3 years. So at a very minimum, you should keep your tax returns for a 3-year time frame. However, the IRS, if they want to say that you failed to report some income or that you claimed a loss for a bad debt or worthless securities, they can actually come back between 6 or 7 years. So if you want to be completely safe, save it for 7 years, and then you won't have anything to worry about if they ever come back. You want to not only save the tax return, but also the supporting documents that go along with it. And when you did get past that time frame, whether that's 3 or 7 years for you, make sure that you dispose of your old tax documents securely. Make sure that they get shredded so that your personal information doesn't end up in the wrong hands. For those of you that are clients of Hammond Iles, we do offer shredding at our offices. So when you stop by or come in for a meeting, feel free to bring along some shredding, and we'll be happy to shred it for you in a secure manner. So for those of you that may be new to Hammond Iles Wealth Advisors, just want to take a moment to share how we may be able to assist you. We offer free conversations with a financial coach at any time. You can contact our office or go to our website at hiwealth.com. In the top right corner, you'll see a button that you can actually schedule it yourself at a time that's convenient for you. One of the things that's unique about Hammond Iles, because we strive to work with families across 3 generations, is that we have no minimum investment amount. We know everyone starts from zero. And so our youngest client at 10 years old started out with $700 of birthday and holiday money. And we work with people of all ages across all generations. As I mentioned earlier, recordings of this webinar, as well as all of our previous webinars, are hosted on our YouTube channel. And we also started about 2 years ago releasing Financial Friday videos, which are a quick 60-second message every Friday on a financial topic. So it's a quick way to get a little bit of financial information on a weekly basis, and you can do that either on our YouTube channel, or if you follow, connect, or like us on social media, on Facebook, LinkedIn, or Instagram, you'll also see our videos there. There are also a number of resources on our Hammond Iles website, including our blog, which is another way of gathering information. I do have an updated blog information that got posted last month that shares the contribution levels for retirement plans and what those adjustments were for 2025. So if you want an update on that, that can be a great place to get some additional research. And as always, you're welcome to reach out to our office at 1-800-416-1655 or contact us at hello@hiwealth.com. So with that, I want to thank you for joining us. We strive on providing this information to you to provide a clear path to purposeful living. And I thank you for your time today, whether you're here live or watching this video online.